Hi friends, welcome back everyone to India Can Fly. This is Prince once again here. So friends, you would have many times tried the calendar strategy and there are lots and lots of strategies available on YouTube as well. You would have tried it all, you would have tested it as well. But today we are going to see a modified calendar, something which is modified by me for my requirement, and I'll explain to you what are my requirements. I'll just explain to you a few of the challenges which I face and why is that I have done the modification. Friends, the main thing with calendar which comes is the VIX. So many people don't know when is that we need to take the calendar. They take even when the VIX is very high. So I have come out with a strategy where you can take it in any kind of VIX. You don't have to worry whether the VIX is rising or the VIX is coming down. I made an arrangement in such a way that it will take care of everything. Second thing is sudden spikes. So why we use this calendar mainly is because get to avoid these spikes. So most of the times when we get spikes in a normal iron condor or iron fly and all those things, when spikes happen, you make a lot of losses. That's why they want to move to calendar where the cushion is very nice. But then again, they'll have many other issues. So that is why I have done modifications. So that is one more thing which is addressed. You won't have issues with the sudden spikes. Next thing is the consistent profits, consistent income. Okay, friends. So calendar is a very safe strategy. You all know that, and it has the potential to give you very consistent income, regular income. And I'm not saying you that you'll get monthly 100% income. It is that almost 80 to 70% of the times you will make profits, and there will be few months where you'll make a loss, but you need to get out of the losses quickly as possible. So you can keep a capital portfolio of almost 3 to 4% capital loss. If at all you reach that loss, you can exit your positions. That is the stop loss which you need to keep. So this will occur. Yes, you can't avoid the losses. It will happen at least twice or thrice in a year, and you have to be ready. Friends, this is a monthly position strategy which I'm recommending, and first practice on a monthly swing trading, and then when you're comfortable, only when you're making consistent profit, then you can start moving to your weekly strategies, weekly expiries as well. Less. Next most important thing is this requires less monitoring, because you know that for working, if at all you're working, you can't monitor your screen regularly, you can't do intraday trades. So this is suitable for people those who are working. You just have to monitor once in a while. So let's say in a day 2 to 3 times you just have to look into your screen, or at least in the start of the day and end of the day, and you can keep your triggers. So we will be having the points at which we need to do the adjustment. So you just have to keep your alarm alert whenever the price reaches at that particular level. You'll get your trigger, and then you have to do the modification, the adjustments. And also it's not that adjustments you have to do immediately. You can take your time, you can do your adjustments within 5 to 10 minutes of your time as well, because we are in a completely hedged positions. Okay, friends. So without wasting much time, let us enter into the trade. I'll show you how to take the entry, and also I would recommend you to keep, initially when you're starting off with the strategy, to keep don't do your adjustments. You can just wait for your targets to achieve or your stop loss to achieve, and slowly, if at all you are an experienced trader, you can learn the adjustments as well. Adjustments are a little bit tricky. I do little bit of aggressive adjustments in this, so I'm not recommending it for everyone. Only in case if you're ready to take big profits, and if you're ready to do big adjustment, risky adjustments, you can follow my adjustment style. And purely this is my trade, my style of trading. So first I recommend you to do your back test, for do see how the performance is. If at all you're comfortable, only then you can follow it. But I have been using it from a long time, and I'm feeling it very good. Okay, friends. So so I just opened the simulator just to show you how we take the entry, and then also I'll explain to you how we do the adjustments as well. So I would always recommend to do it to the Nifty. Bank Nifty will be very volatile, and Nifty I think would be a better solution. Okay, so I'll just show you the latest one, latest expiry in August, where there was good movement as well. So it will really help you. Okay, so on the close, on the end of the day, we can take the positions. So let's say I'm taking the positions at around 3 o'clock. So you can keep your alarm at 3 o'clock, and whenever the expiry is getting over for the next expiry, you can always strike your trades at 3 o'clock. Or otherwise, next day, Friday morning, also you can take your positions. But why to lose that small theta decay even on Thursdays? So I recommend go on Thursday itself. So you all know on calendar what we do. So on calendar, what we do is present month, that is the present expiry, 29th expiry. We will be selling the ATM options, and then we will be going and buying the next month. So in this case, what we're doing is we are not going to buy the same ATM options of next month. We will be trying to match the premiums which are available, which we have got by selling the options. So in this case, we can see that on the call side, we have got a premium for almost 328. So here I go somewhere close to 328, and you can see 346 is there, so I am buying this strike which is 25,400. Always try to take strikes which are close to hundreds, so that what happens, you won't have the issue of liquidity. Now coming to the put side, you can see the premium which I got is 312. So I come to the put side and I take something close to 312. I can see 24,700 is having a premium which is close to my sold options. So you can just observe here, the call options I have sold both in the present month, and I have bought the call and the put options in the present month, and sorry, I have bought the call and put of the next month, this which you all know about the calendar spreads, right? Now let us look into the modification which I have done. So I'm just adding one more call and one more put of the sold legs which I've taken in the present month. So you can see I have added both, and then for hedging I am just going to take a buy option as well. So basically what I'm doing is I am just adding an ion condor or ion fly, whatever you call it. Okay, so what I do is, for taking the strikes, I just add both the premiums. So you can see I have got 328 plus 312, which comes to close to 600. So 600 points far I'm going and taking my hedges position as well. Okay, so you can see the initial position strikes which I took was for a calendar, right? And then next I'm doing an iron condor, so I'm going to 600 points far, and then I am buying an option. Same way here also I am moving 600 points far, 25,600. Yeah, here it is. So I went 600 points far on the both the sides, that is the call and the put, and I bought a option on both the legs, that is on call and the put. So now you can see my position is completely hedged. So initially I can see I'm having two lots of call options on the same strike, on the same expiry. On the latest expiry I have taken two legs, and then on the next month expiry you can see I have taken two buy options of call and put, which are matching the premiums of the sold options which are taken. And then again the same expiry, to make the position fully hedged so that I don't have any headache, and what I do is I take add both the premiums what I've received, and then I add it and take the strike on the present expiry. So that is same 29th August. So you can see 29th August, 29th August, then 26th September, 26th September, and again 29th August, 29th August. Now comes the most important thing. This is a position, okay? This is a position where you can see the maximum profit is 19,857, the maximum loss is 14,647, risk reward ratio is good, probability of profit around close to 50%. All those things are fine, and you can see the capital record also is 1 lakh. Okay, so one thing which I do you have to observe very carefully is that these hedge positions I always take only close to the end of the day. Again, if you're a full-time person, full-time working person, and you can't monitor trades regularly, then you can go with the safe position where it is completely hedged. But in case if you're a person who can actively involve in trading, then what you need to do is that you don't have to take these two positions during the daytime. You can just exit these two positions in the daytime, and then end of the day when you're closing your trades, you just have to take the hedges and carry forward to the next day. So meaning to say, at 3 o'clock you can take the safety net, and then next day morning you can again exit the safety net. You might receive a small transaction cost, yes, but it will save you from your huge theta decay which is there. So in the daytime you can see we'll be making very good benefit of the theta decay as well, and this is how your position will be in the daytime. Okay, so 23,000, and you can see the maximum loss. And whenever it is every day, whenever 3 o'clock when you're closing your position end of the day, you can just take the hedges. This is what I told you. This is my style of trading where I like to make maximum use. So this is what I do. So this is one thing which you have to observe. Second most thing, friends, is the adjustments part. So you have to keep your trigger alarms at these two exit points, that is the break-even points. And also you can see that it's not that immediately when it triggers you just have to do the adjustments, because it's a calendar, and we will have a safety net. And also, in case if you are monitoring your trades, you'll know that whenever the spot price move towards your break-even points, and then you have to be ready for your adjustments. Now let us come to the adjustment points. Okay, I'll just show you how do we do the adjustments. We are slowly moving towards the bottom side. Okay, so here you can see that morning when the market opened itself, it has moved a big gap down, and this is why we say always you need to have the hedges. You can see the hedges has saved us here, so that is why we always keep the hedges in the night for safety net. That is why I particularly took this example of August month where there were sudden violent movements as well. So you can see already it has come down by almost 3095, but it's not that you have to wait till this 932. Initially when the market opened itself, we can see that this was a huge gap down, but in this case it is a night issue, night movement which has happened, that spike which has happened in the down. You can see at 326 the loss is only 0.4%, that is minus 388. You can see it has not reached a break even, but the next day 5 minutes market open itself, we can see because of the gap down, the uh, loss has come down significantly. The loss has increased significantly. Okay, so now I'll just show you adjustments. My main intention was to show you the adjustment. That's why I took this particular month. What is that we need to do in this kind of adjustments? Whenever the don't have to wait till this market moves so much down. As soon as when it reaches this break-even point, you can do the adjustment. In this particular case, it's a gap down movement in the night, so we can't help it. But I'm just explaining the position. I'm explaining you the adjustment which we need to do. Okay, now just carefully observe the sold strikes. You can see that call is in a profit of 10,480 and put you can see is in a huge loss. So what we need to do here is we are having two options of call and put. We just have to exit only one leg. Okay, I'll just show you. We just have to exit only one leg, right? So now you can see that in case the market continues to go down, we will be making huge profits in this. So let me repeat to you once again. Whenever the break even reaches, we just have to exit one of our sold leg only, not both the legs, only one. You can see here I have two legs of 25,000 put, in which I have sold only, which have closed only one leg. Now what happens is, if at all you see the look into the graph, see this won't be exactly like this. Whenever we come close to the break even and we shift our positions, we'll have a good backup over here as well. I'll just show you that case as well. Okay, let's say imagine this is a scenario where we have come close to the expiry, I mean close to a break even, and now when you're exiting a positions, we can just see I'm just closing one leg, so you can see that how the graph is. This is exactly the graph which I need. Okay, you can see in case if the market continues to go down, we will be making huge profit. This is how we get benefit of this. Is what I told you. It's a very risky adjustment, and we tend to make very good profits in this. Whenever the loss happens, the loss is going to be minimal, but whenever the profits happens, it's going to be very huge. This is what is the concept you're selling. And in case if the market reverses also till this center point of the peak, you can see that even if the market expires in this gap also, we have a cushion over here. We will be making profit in this region as well, right? So in case both the we're getting both the benefits. In case the market goes down, we'll be making profit, or in case if the market remains in this place also, again we will get profit, and in case the market reverses and comes back a little also, we'll be making profit. This is how this adjustment is benefiting us, and this is going to be a purely directional adjustment. And you might ask me, then how is that you do your adjustment? You want to pay, you want to be ultra safe, you don't want to take such, you don't want to get such big profits, you want to be very very safe. Then simple thing is, when the position reaches your break even, close all your positions and shift your strategy, shift your entire strategy. By this what happens is that again you will be neutral, and then you can get the theta decay benefit. But let me tell you friends, the major profits is in directional trades. You make very good profits, but whenever you make loss, the loss is going to be minimal. But whenever you make profits, the profits are going to be huge. For that, this kind of adjustment is required, right? So once it comes to into this positions, next what is that? If it continues going down, then you are well and good, you always make very good profit. But in case if the market reverses, it comes back to this position, the you can see the tip of the cone. If it comes back to this position, you have to add back the leg which you had sold. That's it, simple. Even in case of the market goes up, or even in case of the market goes down, when it reaches the break even point, just exit the leg which is making loss to you, and then make it a directional trade, and then enjoy the trend. And in case if you feel it is reversing, then you have to get back to your own positions. And mind you, keep an overall loss limit. You should not lose than more than 4 to 5%, or I say worst to worst case 3 to 4% of your portfolio should be your target. Don't lose more than that. And do your back test thoroughly. Only once you're confident, you do the positional trading, monthly positional trading. And once you're confident with the monthly positional trade, only then go into your weekly trading. You can do it with weekly as well. It's weekly will be generating more and more very good profits for you, regular consistent incomes, but you need a lot of practice for that. Okay, friends, hope you like the strategy of this modified calendar which I am doing it. And in case if you have any doubts, you can always WhatsApp it to me. Any doubts, any other confusion, always. Thank you. 8095 876525 is my WhatsApp number. Thank you.